What fund or investment should you have in a taxable account? Get this question a lot. Got it yesterday on the live stream we did. My man Jeff said he had $100,000 and he didn't want to keep in the bank. He'd like to get it growing, but he wanted to know if I had any suggestions on a type of investment. And the answer is absolutely. And everyone discounts taxable accounts. They say, oh, I need to have my IRA, my Roth, and man, I get that. But taxable accounts, don't overlook taxable accounts. There's huge benefits to taking advantage of taxable accounts. Gigantic. So let's dive into this. I'm going to share with you two things here right quick. My recommendation, of course, I don't know you. I don't know anybody here, so you do what you want to do. But if I have a taxable account for your old buddy Josh, it's going to be small caps, growth-oriented stocks. And we can look at large cap growth-oriented stocks too. But I want an ETF in particular. I don't want a mutual fund. I want an ETF because the tax situation are much more favorable for exchange-traded funds than they would be for mutual funds. And that's one of the benefits of ETFs. They can do in-kind transfers, so they're not selling shares when there's redemptions. I don't want to get too deep in this, but the nature of how ETFs are set up, which mutual funds don't have the same privilege, which is interesting because a mutual fund manager is like, yeah, there's really no reason to have a mutual fund in a taxable account. There's none, given that ETFs serve the same purpose, a whole lot more tax efficiently. The only reason would be if you're dollar cost averaging, and that way, because the mutual fund is always open-ended. There's generally no fees or commissions to buy $100, whereas an ETF, you got to make a trade every time you want to put $100 into it. So the only time you'd want to have a mutual fund in a taxable account, if you're doing dollar cost averaging, you're putting $100 or $250 a month or something like that. Then, in my opinion, mutual funds are preferable. Other than that, ETF's the way to go. All right. So what I'm saying is, look, we want small cap. The reason we want small cap, and you can have large cap too, is just generally speaking, small caps don't pay any dividends. It's just, or not much, relative to large caps. All right, large caps are blue chips. Large caps are more established funds or stocks, whatnot. Small cap growth is what we're looking at here. So generally speaking, small caps don't pay as much dividends, and the growth side, they don't pay nearly as much dividends as the value side. And if we look at the Morningstar on VBK, which is small cap growth fund, we'll see the SEC yield is 80 basis points, so 0.8%. So if you had $100,000 in here, it would pay you, I guess that's $800 a year in qualified dividend income. Most likely qualified. I don't know exactly how much that'd be qualified or not, but that's minimal. That's minimal. You had $100,000, right? In that, so if you had $100,000 and paid 1%, you'd pay $1,000. Yeah, so it'd be $800. That's not going to make or break you from a tax perspective at all. Now, if we look over to small cap value, though, on the other hand, let's see what this guy is doing, 2.36%. So $100,000 here is going to pay you $2,360, or 3 times what the $100,000 in the small cap growth fund. And this is why you want your dividend stuff in your Roth IRA particularly. So we want growth in our taxable account because it's not paying us much taxable income. I mean, a little bit, but not much. And it's more growth oriented. So theoretically, actually the 12-month yield is 0.64, but we'll go with the 0.8. But anyway, theoretically, there's more. The growth has more growth potential. I don't know if I necessarily buy that, but that'd be the idea. It doesn't have a lot of. It's reinvesting its cash into the stock to perpetuate some growth. Is the idea. So growth is tax-free until you sell it, and if you never sell it and leave it to your heirs, it's tax-free to your heirs because of step-up in basis. Whereas value, they're paying out those dividends, so they're paying what a value stock is. They're paying out more dividends because they're not expecting as much growth. So a value stock will be a utility company or something like that. So they're not expecting as much growth. So the cash that they're getting, they're paying out in dividends to the shareholders. Now, the interesting thing about value is the reason it's value is because the shares are beaten down a lot. So it has low price to earnings ratio, low price to book ratio, and high dividend yields. And you can see it right here, high dividend yield 2.36. So the value, it really has more upside than I think a lot of people recognize. They say growth has more upside. Either way, I'm splitting the difference here. But I am just looking at for something that doesn't give me a lot of income. And so now something else we have to think about with ETFs relative to mutual funds. Mutual funds pay out capital gains every single year. Mutual funds pay out capital gains, dividends, and ETFs do not. Vanguard ETFs don't pay any capital gains. So if we go down here to the tax efficiency, I think Morningstar shows this. I want to show you something here. Let's see here. Do they not show it on the ETFs? Yeah, they do. Okay. So look at the tax efficiency, and this is on, let's go small cap value. The 15 years since inception, it's averaged 8.59% a year before tax. After you have factor in taxes on distributions, again, no capital gains, it's all dividends, you lost about 60 basis points. So not much at all. But you did lose a little bit of money, and that's just because you got to pay tax on the distributions. Here, if we go to small cap growth, let's see what we got here. And I'm going to show you something that's even more dastardly here in just a second. 9. Here we go, because there is no dividends hardly. So 9.55 since inception before tax. After tax is 9.3. You're just losing 25 basis points because there's minimal taxation. Because it doesn't pay that much in income. That's why you want this in your taxable account. So stay with me. I'm going to show you something else that will you'll say, whoa, watch this. I'm going to pick on the Franklin Income Fund, FKINX. This is absolutely not a fund you want in a taxable account. And partly it's because it's got bonds in here, but also has dividend-paying stocks. And so what we'll see here is we have a 30-day yield of 3.82. And again, partly is going to be attributed to the stocks and the dividend-paying stocks it has and the bonds it has as well. Presumably, there's probably going to be some real estate investments in here as well. But watch this. So it's a good fund. I mean, it's a great fund. 4-star rating. I'm a huge fan of this fund. Not what you want in a taxable account. Watch this. All right, so Franklin's been around since 1940-something, the income fund. It's kicked butt and taken names for many, many, many years. Done wonders by many of its shareholders. But watch this. 10.06 is the before tax returns. After taxes are considered, it's lost half. It's lost 50% of its returns because of taxes over since inception. And the same, look, you look at 15 years, 6.46, 3.81, 8.685. I mean, you can see, I mean, look at this. Over 5 years, after taxes, you basically made no money. This is the thing that drives me insane about investments, is that if you're not doing the tax strategies correctly, you are potentially losing all of your money. I don't understand why people don't get this. It actually annoys me to no end. So basically, you're losing half the portfolio, but you're taking all the risk, but you're losing half the portfolio for taxes. We don't want stuff like this, please, in taxable accounts. No bonds, no bonds. One more time, no bonds. No dividend stocks, minimal. If you have to get some dividends, keep it minimal. No mutual funds, no bonds, no dividends, no mutual funds. We want growth, ETFs, and stocks. Stocks that are growth-oriented, exchange-traded funds. No bonds, no dividends, no mutual funds, not in taxable accounts. So what happens here is you are paying that income tax every single year. Now, this is, by the way, you saw us paying 3.86% or something as a yield. A portion of that is not just as income, but a portion that is ordinary income, not qualified dividends because it's a bond. So it's a complete tax catastrophe relative to what it should be, which this right here, if you're going to own it, and again, I don't like bonds, so I wouldn't own it, but this should be in your traditional IRA for sure. All right, because of what's going to come. This is the issue where you have stocks and bond portfolio to combine, because it's harder to manipulate which should be what, because this is a fund of funds. You got stocks and bonds. Some of the stocks would be in Roth, the bonds would be in your IRA. It definitely should not be a taxable account, but because it's a mix of stocks and bonds, you're like, what goes what? I'm like, that's why I don't like it. So they just separate them too. Now, but Josh, you love the Wellington Fund. Yeah, I do. That's the same kind of concept. Wellington Fund's the same thing, because that's stocks and bonds. What do you put in where? Do you put it in the Roth? Do you put it in the taxable account? You don't put it in the taxable account. Do you put it in the Roth, or do you put it in the IRA? And it should be a whole lot easier. So your IRA should consist of your bonds. Your taxable account should consist of stocks, dividends, all right, and ETFs. No municipal bonds, for the love of me, unless you're a very conservative investor. We don't want municipal bonds. But Josh, are tax-free. Don't do that, please. We want bonds in your IRA. You get a higher yield. They're coming out as ordinary income anyway, as a taxable consequence. If you're going to have bonds in your IRA, stocks that are oriented towards dividends, real estate investment trust, should be in your Roth. Hope this helps, man. That's what you should put in your taxable accounts. stock funds, growth-oriented, low dividends, and ETFs. That's what should be in your taxable account. So if you have any questions, put in the show notes. And again, I'm not making recommendations on any of this stuff. That's up to you to decide, but we'll see you next time. Thanks now.